First, it's the beginning of a new month, all right? And you know what? In almost every new month, especially after a very big run, we get a period where large funds decide to take something off the table. It's not a dumb idea. Given that no one was expecting this kind of selling, witness the clueless pajama traders as of last night and this morning who were still buying. You have to be wary. You know, it's hard to find the other side of the trade when you're selling. There's so many ETFs that contain these cloud names that it's possible for one or two of them to bring down the whole group. It's ridiculous. It is the tail wagging the dog. But it happens. We've seen it regularly since the software as a service meltdown in April of 2014. Now, you have to be careful because these kinds of moves can be brutal. And more important, they can be longer lasting than the typical dip. You dip buyers focus. In 2014, the whole group got hammered, led by Salesforce, which plunged from $67 to $48. Given that Salesforce reports tomorrow, I recommend proceeding with caution. You know I love this company. And ordinarily, I like it when a stock pulls back going into earnings. My first instinct is to say the bar's now gotten lowered. It's been de-risked. But now I worry that it may be rolling over along with the whole cloud cohort, regardless of how well it's doing. And that worries me, even though, again, I'm a big fan of Salesforce. And it is a key position for my charitable trust for a long time. And you can follow along by joining the ActionAlertsPlus.com club, where I'm going to overwhelm you with bulletins just about this situation. Look, the stock of Salesforce has experienced 4 major declines since 2014. 4. You know, and not one of them ended in a day. They were all multi-day or even multi-week shellackings, including the one we saw earlier this year. If you're nimble enough to be a trader, then I actually would lighten up here and then buy it back at a lower level. But for most people, that's a bad piece of advice. I think you should stick with it through the pain, because you never know if you'll be fast enough to actually get back in a better price. Now, the story here is still fantastic. Take a look at print out the story from 2008 to here, and you'll see. You won't even be able to see declines like the one I'm talking about. We just checked in with Salesforce at their big Dreamforce conference 2 weeks ago, and they told an incredible story, but that won't protect the short-term turbulence. Again, it may not. I'm just concerned. I'm concerned because this cloud sell-off looks like the real deal. Remember, it's not the ETF-driven selling, not that it's so heavy. It's that the buying is so thin. Think of ETF selling as being like a machine gun, while single stock buying is more like a bolt-action rifle. The guy with the rifle simply doesn't stand a chance until the machine guns run out of ammo. Typically, that takes 2 or 3 days for the stocks to get low enough that the selling dries up.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.